The AI bubble, Silicon Valley's trillion-dollar gamble against China. In the time it takes to draw a single breath, the gears of the global economy have shifted in a manner that defies conventional human comprehension. We often discuss big tech and massive investment in the abstract, but the figures currently being deployed toward artificial intelligence represent the largest concentrated bet in history. Between 2025 and 2026, the world's leading technology firms are projected to spend between $725 billion and $1 trillion on the AI buildout. To grasp the staggering weight of that number, one must look beyond the zeros. If you would spend $1 million every single day from the day Jesus was born through the fall of the Roman Empire, the Renaissance, and both world wars, you still would not have spent as much as big tech is projected to spend on AI in this year alone. This represents a capital injection of approximately $2 billion every day, $83 million every hour, or roughly $23,000 every single second. In the few minutes it takes to read this introduction, more than $4 million will have been committed to a technology that many of its own architects admit they do not fully understand. This is no longer merely a corporate maneuver. It has become a matter of state survival. The White House recently signed an executive order for the Genesis mission, a federally funded push to win the race for artificial general intelligence that analysts describe as the Manhattan Project of our era. We are witnessing a financial and geopolitical escalation so vast it has transformed from a market trend into a transformation of the physical and fiscal landscape, a trillion-dollar gamble where the stakes are nothing less than global hegemony. We find ourselves at a crossroads of narratives. To one half of the investment world, AI is the most significant breakthrough since the Industrial Revolution, a leap that will redefine labor and intelligence. To the other half, it is the most egregious speculative bubble in history, destined to collapse under the weight of its own energy requirements and unproven returns. Yet, while the public debates whether AI is real, the American economy has already hitched its wagon to this singular star. A recent analysis by Harvard economist Jason Furman revealed a startling reality. In the first half of 2025, investment in information processing equipment and software, the backbone of the AI buildout, accounted for a staggering 92% of all growth in the United States GDP. If one were to strip this AI-related spending from the equation, the American economy would have grown by a mere 1/10 of 1%. This suggests that AI is not just a burgeoning sector, it is currently the sole pillar holding up the facade of American economic expansion. The central question is whether this trillion-dollar gamble is building a new frontier of productivity or a fiscal black hole where capital is swallowed by depreciation and energy bills never to return. The current market environment is defined by what analysts call the Great Narrowing. For decades, the top 10 companies in the S&P 500 typically accounted for 18 to 23% of the index's total weight. Today, that figure has doubled to 40%, a level of concentration not seen since the height of the dot-com era in 1999. These 10 names now carry 41% of the index's weight, while generating only 32% of its earnings, meaning the market's valuation has run dangerously ahead of its actual profit-generating capacity. To understand where this leads, we must apply capital cycle theory, as old as Adam Smith's The Wealth of Nations. Smith argued that when capital floods into one trade, mutual competition naturally lowers profit. The cycle moves through 4 distinct stages: the flood, a new technology appears, returns look attractive, and capital pours in. The boom, competitors pile in faster than demand can grow, building excess capacity to chase share prices. The collapse, oversupply crushes returns, prices fall, and the original builders go bankrupt. The inheritance, new owners buy the bankrupt assets for pennies on the dollar and finally collect the value of the infrastructure. History is a relentless witness to this pattern. In the 1840s, Britain was gripped by railway mania, where investment hit 7% of the entire economy, and Parliament passed 272 separate acts for redundant lines. The lines were built, but the original investors were wiped out when revenues were found to be 75% lower than promised. In the late 1990s, $500 billion was poured into fiber optic cables, 85% of which sat unused in the ground as dark fiber for years while companies like WorldCom collapsed. In the 2010s, the shale revolution saw U.S. oil production double, followed by the bankruptcy of 200 companies when supply outstripped demand. In each case, the technology was real, but the financial mania was not sustainable. AI is following this exact pattern, but on a scale that dwarfs the railways and the fiber optic booms combined. For the last quarter century, investors have been conditioned to believe that software is the perfect business. You build a program once, like Microsoft Excel, and every subsequent customer represents almost 100% profit because the marginal cost of distribution is zero. This is the infinite margin myth that is currently being misapplied to AI, but the reality is fundamentally different. AI does not follow the software model. It follows what is known as the restaurant model. Every time a user asks a large language model a question, it consumes electricity, wears down specialized chips, and requires massive compute power. This means that as an AI company gains more customers, its costs increase linearly with its revenue. There is no gap opening up where profits can hide. OpenAI provides the most visceral evidence of this broken economic model. In 2025, the company reportedly burned through $20.9 billion in a single year. Despite billions in revenue, its losses increased eightfold, as it spent $5.7 billion, 44% of its entire revenue, just on sales and marketing to keep users on the platform. This is a business model where you lose money on every meal served, hoping that eventually scale will fix the mathematics. However, unlike Amazon, which lost money building a physical logistics network that competitors couldn't replicate, AI companies are spending billions on models that are increasingly being commoditized by rivals, who can copy the homework for a fraction of the price. To maintain the appearance of hypergrowth, the AI industry has resurrected a tactic known as round-tripping, or circular financing. This is a mechanism where a supplier effectively funds its own demand. The loop works with clinical precision. Nvidia, the dominant chipmaker, invests hundreds of millions of dollars into an AI lab, or a neo-cloud provider like CoreWeave, Nebius, or Iron. These providers then use that very same investment to buy Nvidia's chips. Nvidia records this as a sale and revenue growth, which drives its stock price higher, giving it more capital to reinvest and keep the cycle moving. In some instances, Nvidia has even agreed to buy back unused chips from its customers if they cannot find enough renters, effectively removing all risk from the transaction to keep the demand story alive. Nvidia even owned 5% of CoreWeave when it filed for its IPO, anchoring the deal with a $250 million order to boost investor confidence. This is not the only unusual arrangement. AMD reportedly gave OpenAI the right to buy 10% of AMD stock for a mere 1 cent per share, provided the stock price rose after the partnership was announced. This creates a multi-headed dependency where everyone is betting on everyone else in a small, closed circle. This is the same closed-loop accounting that defined the Enron era and the vendor financing tricks used by Lucent and Nortel in the late 1990s, a system that manufactures the appearance of end-user demand, when in reality the industry is simply passing the same dollar around in a ring. The ultimate justification for the U.S. AI buildout is a geopolitical one. The West must spend whatever it takes to beat China. However, the spending data suggests a massive inefficiency in the American approach. The U.S. is outspending China by a ratio of nearly 10 to 1, with the U.S. projected to spend $1 trillion compared to China's $123 billion. China has adopted a distillation strategy that bypasses the need for trillion-dollar R&D. Rather than spending billions to train a frontier model from scratch, Chinese firms are copying the homework. By studying the outputs of American models, they can train their own models to achieve 90% of the quality at a fraction of the cost. When a company like Meituan, the Chinese equivalent of DoorDash, can build an AI that competes with American labs for a tenth of the price, the $1 trillion moat Silicon Valley believes it is building is an illusion. You cannot recoup $1 trillion in capital if your competitor is giving away the same utility for free or at a massive discount. The geopolitical tension was recently laid bare when U.S. Commerce Secretary Howard Lutnick reportedly ordered Anthropic to cut off foreign nationals from its most powerful models. This order, which included even employees who were not U.S. citizens, sparked an immediate backlash. France subsequently fired Palantir, and the French Prime Minister stated that they cannot depend on partners capable of turning off the tap. Germany and Spain have followed suit, instructing their firms to stop signing deals with American AI providers. The world is finding out it has a choice, and that choice, powered by Chinese distillation, is 7.5 times cheaper. The AI mania has moved beyond the digital realm and into the physical world, creating massive environmental and financial ripple effects. Projects like OpenAI and Microsoft's Stargate data center are projected to require 10 gigawatts of power, enough to fuel 26 million homes or the entire state of Texas. Because the U.S. utility grid cannot handle this sudden surge, companies are bypassing environmental regulations by installing gas turbines directly at data centers in states like Tennessee. This infrastructure is largely being funded by private equity and private credit. Firms like Blackstone have acquired over 450 data center companies since 2022, betting that big tech will pay any price for space. However, this creates the risk of stranded assets. If the demand for AI tokens cools, or if chip rental prices continue to fall, as they have recently, dropping from $3.20 per hour to $2.80 per hour for certain Nvidia chips, which is below break-even for many operators, these massive data centers could become the railroads to nowhere of the 21st century. When these projects are funded with high-interest private debt, any slowdown in demand causes the entire leveraged structure to collapse, potentially triggering a contagion that spreads through the shadow banking system. We are already seeing the hairline fractures that signal the end of a mania. The first major tell occurred in June 2025 with the SpaceX IPO. Despite being the largest IPO in history and raising $85.7 billion, the stock peaked at a $2.7 trillion valuation before shedding $900 billion in just 2 weeks. This wobble has reportedly scared other major players. OpenAI is now considering pushing its listing out to 2027, with Sam Altman calling any valuation below $1 trillion a non-starter. A more subtle yet more alarming tell comes from the world of forensic accounting. Michael Burry, who famously predicted the 2008 crash, has pointed to a specific accounting trick being used by big tech. Google, Microsoft, Meta, and Amazon have all quietly extended the useful life of their servers and network year from 4 years to 6. This single maneuver cut Google's depreciation costs by $3 billion in 2023, magically boosting reported profits without any actual increase in business activity. If this hardware becomes obsolete in 2 years due to the rapid pace of AI development, these companies will face a massive black hole of unrecognized losses. The critical trigger to watch remains capital expenditure. In the dot-com bubble, the Nasdaq peaked in March 2000, but companies continued spending on fiber optics for another year. The market did not wait for the spending to stop. It changed its mind when the story stopped making sense. Analysts note that the first hyperscaler to pull back on AI spending will likely be rewarded by the market. In an industry of followers, once one CEO admits the ROI isn't there, the rest will follow suit. Another warning sign is the credit spread, the gap between the risk-free rate of government bonds and the interest rates companies must pay. Currently, spreads are very tight, at around 2.6%, suggesting lenders feel very safe. However, spreads were also at 2.5% in early 2007, months before the financial system began to rupture. When coupled with a Shiller-Cape ratio of 40, a level seen only once before, in 2000, the signals suggest we are approaching a historic inflection point. There's an old adage in business: the pioneers get the arrows and the settlers get the land. The pioneers of the AI era, the labs, and the early investors are currently taking all the hits, the risks, and the losses. They're building the infrastructure, the data centers, and the power grids at a cost that is arguably unsustainable. If history and the capital cycle theory hold true, we are looking not at a hoax, but a massive over-deployment of capital. The technology will remain. The 100 gigawatts of data center capacity and the millions of miles of fiber will stay in the ground, but the people who paid for them may not survive to see the profit. We are moving into the inheritance phase, where the next generation of companies will buy these server farms in the suburbs for pennies on the dollar. The black hole of AI is currently swallowing billions in depreciation and energy costs, hidden behind clever accounting and circular financing. Whether it ends in a sudden rupture like 2008 or a slow, rolling deflation, the current AI story is approaching its final chapter. Navigating the coming collapse requires understanding that while the technology may indeed be the future, the current price of admission is a gamble that most will lose. We're building a new world on the wreckage of a trillion-dollar bet, and only the settlers who arrive after the crash will truly inherit the land.